Why would the US Treasury buy back long maturity bonds like 10 to 30-year Treasuries and pay for them by issuing shorter-term bills and notes? At first glance, it sounds unusual. Why replace long-term debt with short-term debt? But this kind of move can make sense when the government wants to improve the structure of its debt, lower near-term financing costs, or respond to market conditions. The key idea is simple. Long bonds lock in borrowing for decades, but they also tend to carry higher interest rates. Short-term securities usually pay lower yields, at least at the moment they are issued. So if the Treasury repurchases long bonds and finances that buyback with shorter debt, it may reduce interest expense in the near term. That can be attractive when long-term rates are high compared with short-term rates. Another reason is to manage the maturity profile of federal debt. The Treasury doesn't want all of its obligations coming due at the same time, and it doesn't want to be forced to borrow heavily in one part of the yield curve. By actively changing the mix of maturities, it can make debt management more flexible and, in some cases, more efficient. This can also help market liquidity. If certain older long-term bonds have become less actively traded, buying them back can simplify the market and concentrate trading in newer benchmark issues. That can improve pricing and make Treasury markets easier to navigate for investors. There's also a strategic reason. If the Treasury believes long-term yields are temporarily elevated, it may choose to reduce exposure to those expensive rates. Issuing short-term debt instead can save money now, though it creates a different risk: refinancing risk. Short-term debt has to be rolled over more often, so if interest rates rise later, the Treasury could face higher costs more quickly. So this is really a trade-off. Buying back long bonds and issuing short securities can lower current borrowing costs and reshape the debt portfolio. But it also increases sensitivity to future rate changes. In other words, the Treasury may be swapping long-term certainty for short-term savings. That's why these decisions matter. They are not just technical accounting moves. They affect how much the government pays to borrow, how stable its financing is, and how the bond market functions as a whole. If you've been enjoying the video, do me a quick favor. Hit like and subscribe. It's free, it takes just a second, and it helps the channel more than you might think. A like tells the algorithm this is worth sharing, which means more people get to see the content you're already watching. And subscribing means you won't miss the next upload, the next tip, the next story, or the next big moment when it drops. Honestly, it's one of the easiest ways to support a creator. No payment, no commitment, no catch. Just a simple click that says, yeah, keep making this stuff. And if you really want to help even more, turn on notifications so you're the first to know when a new video goes live. That way, you never have to go searching for it later. So if you're still here and you're enjoying the content, go ahead and join the community. Like the video, subscribe to the channel, and let's keep this thing growing together. It's free, it's fast, and it makes a huge difference.